teacher, police and firefighter pensions are being secretly looted by Wall Street. Today I want to talk about how the degenerate risk taking by these Wall Street funds has led to the current crashing economy and billions of dollars in pension money being wiped out. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, this article on Forbes was written by Citadel. He's a pension forensics expert and record-setting whistleblower award winner. He says that teacher, police and firefighter pensions are being secretly looted by Wall Street. It says America's severely underfunded public pensions are allocating ever greater assets to the highest cost, highest risk and most secretive investments ever devised by Wall Street, such as private equity, hedge funds, real estate and commodities, all in a desperate search for higher net returns that, not surprisingly given the outlandish fees and outlandish risk, failed to materialise. Transparency, public scrutiny and accountability have all been abandoned, as pensions agree to Wall Street secrecy schemes that eviscerate public record laws. For nearly a decade, the US SEC has warned investors that malfeasance and bogus fees are commonplace in so-called alternative investments, and more recently, Gary Gensler has called for greater transparency to increase competition and lower those fees. Gensler has stated he'd like to see a reduction in the fees these investments charge, and has also commented on industry abuses such as side letters, which permit private funds to secretly give preference to certain investors, preferences which typically harm public pensions. But yet no one, including the pensions themselves and the SEC, seems to care that the government workers, whose retirement security is at risk, are being kept in the dark. Problem is that these pension funds are seeking higher and higher and higher returns as inflation has been increasing. Back in the day, many pension funds used to solely invest in government bonds and fairly low risk securities, but nowadays they're investing into higher and higher risk securities and placing their money with higher and higher risk hedge funds. These hedge funds are degenerately taking higher and higher risk with public pension money, all to generate larger returns so they can justify their large fees and charge even larger fees. Somewhere along the line, these hedge funds went from investing in fairly low-risk ETF index fund trackers like the S&P 500 to trying to short American stocks and American companies into bankruptcy. Not only has this been incredibly risky and a massive failure for these hedge funds, but it's also been incredibly risky for the pension funds that are investing directly into these same hedge funds. And as we know, this is going to end in a number of hedge funds going bankrupt during the squeeze and unfortunately losing potentially billions of dollars, if not trillions of dollars in public pension money. And Roy Santino actually tweeted at Citadel saying it was a great article you provided for Forbes. Please consider looking into Citadel securities, as this leads into more of the scandal you are referring to. And he said also Rizzo has continued to follow the money into the Caymans and has all of the information needed to provide proof to the SEC that billions, if not trillions, are being siphoned away almost on a weekly basis. And I also wanted to talk about Jan-Jack's thread on the new Reuters article. Reuters posted this article saying the Bank of England tells lenders to brace for an economic storm. It says the Bank of England warned on Tuesday that the economic outlook for Britain and for the wider world had darkened and told banks to ramp up capital buffers to ensure they can weather the storm. Clearly, the Bank of England has also clocked on to the fact that tons and tons of hedge funds are down 90% on the year so far, and therefore they're telling major banks to ensure they have tons of cash on hand when these margin calls start to hit. They've said the economic outlook for the UK and globally has deteriorated materially, adding that developments around the war in Ukraine would be a key factor. And guys, if you haven't already, be sure to sign up to Moomoo using the link in the description below to get 10 free stocks worth up to $25,000 and a guaranteed free share of Lucid on top of that. Moomoo is very easy to use, it's incredibly customizable, and they've got tons of technical indicators and advanced charting tools. Moomoo officially state in their updated customer agreement that they do not benefit from your order flow and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, they clear their trades themselves through Futu Incorporated, which does also not sell your order flow. Members of the Financial Policy Committee confirmed that the Bank of England will double the counter-cyclical cyclical capital buffer rate to 2% in July of next year, and said it could vary the rate in either direction depending on how the global economy pans out. Despite a worsening cost of living crunch, with inflation heading towards double digits, the Bank of England said banks were resilient to debt vulnerabilities among households and businesses. But there's also a very interesting contradiction from the Wall Street Journal that said banks are getting burned by risky debt, imperiling buyout activity. They said Bank of America, Credit Suisse, and Goldman Sachs are among banks that could collectively lose billions on buyout loans they agreed to provide when demand was high. Most interestingly of all, the central bank said it would begin its 2022 stress test of banks, delayed due to the war in September, with results likely to come out in mid-2023. Clearly the UK knows that many banks won't survive the coming recession and has therefore delayed this year's stress tests to mid-2023, after the recession and after the failures. Clearly the Bank of England and the Fed knows the current economic situation is getting significantly worse, and therefore they're warning banks to brace for an economic storm and ensure they have more cash on hand. When these banks start taking on massive losses as a result of the giant loans they've lent out not only to startup tech companies but also to defaulting hedge funds, they will need more cash on hand to survive the current recession. And obviously if these major banks don't have enough cash on hand, they won't survive the current recession, and they also will end up going under as well. And that's why I've warned you a number of times that if you do have all of your cash in one individual bank that exceeds the SIPC insurance thresholds, be sure to move it around into a number of different banks just in case that bank goes under. As Jan-Jack said, lenders are tightening up. The central bank's near zero credit policy is over, and the derivatives and debt bubbles that have been inflated through quantitative easing and the repo program and the reverse repo program too has sent inflation through the roof. Obviously, I've said for some time now the reverse repo program has been bailing out these shorts, and it's effectively put all of these giant institutions and central banks into a massively sticky situation. He says that increased collateral requirements and margin calls are on their way. We see it happening in crypto, and it's going to spill over to broker-dealers, market makers, hedge funds, and their infinite liquidity fairies in the stock market. We're seeing more and more exchanges struggling to survive as investors are withdrawing all of their cash. We're seeing more and more hedge funds, especially crypto-focused hedge funds, being margin called, and we're seeing larger collateral requirements and smaller valuations in these tech companies. And Reza replied saying, facts, the toxic derivatives of CDOs have returned to collapse the financial markets once again, just this time taking a different form. Instead of these hedge funds taking giant risks in CDOs, they're instead taking giant risks shorting stocks and longing stocks with massive leverage. And Jan-Jack said the haircut for the derivatives market is coming for those speculators who have been rolling over and hiding their debts in complex derivative instruments like swaps. He said the FTDs, the swaps, the expiring leap options they've rolled over to avoid taking losses are now on notice. This is exactly what I've been saying for some time now, and every single day we're edging closer and closer to this market crash and to this recession, which effectively we're already in. TechCrunch also posted this article talking about the end of a second straight month of layoffs in tech. As I said, it's not just these tech companies or these crypto companies that are struggling for cash. They're having to lay off massive amounts of staff to obviously preserve that cash because they know the economy is failing. It says June brought another wave of layoffs in tech, with cuts impacting roughly the same number of employees as May. 16,000 employees, according to the tracker. Another layoff tracker paints an even more dire picture, counting 26,000 impacted employees this month, up from around 20,000 last month. Either way, the data is grim. The end of a second straight month of nearly daily layoffs shows how every startup sector, from mobility to fintech, is impacted by the downturn. And it says some companies are laying off specific teams, others are distributing cuts across all departments, and many aren't responding to comments when asked for further information. It then goes on to talk about all of the giant tech companies over the last month that have laid off a number of staff, with some companies even performing a second layoff. I think this really does point to the fact, as quoted by the New York Times, that the chances of a recession are uncomfortably high. The New York Times is saying that economists believe the chance of a recession is uncomfortably high, and the range of forecasts is wide, but economists in general see a rising probability that the US economy will shrink. And as always, guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.